Hey, accounting scholars, welcome to Chapter 12, Section 3. Hey, we ended on this particular slide in our last video where we were talking about determining the net of tax amount. So basically, the cash receipts or expenditures that might be involved in an investment decision, future cash flows, but taking into consideration the tax rate. Same thing with depreciation, same thing with the proceeds from the sale of assets, and the same thing with the proceeds from the sale of an asset that involves a loss. So we're dealing with the tax rate that the business might be paying. So there are some examples of this that I'd like to go over with you. And let's take each one of these one at a time. So let's talk about cash inflows first. So let's say that you have total cash inflows of $100,000, and the tax rate that you're paying is 20%. The question is, what are the net cash inflows? So go back to the previous slide. Look at that particular equation and see if you can make a determination of what the net cash inflows are. And if after you do that, we'll move on to the next slide. So I'll pause here for about 10 seconds. Probably best you stop the video here and go back to the previous slide and do this calculation. Okay, so what's the math involved here? Not very complicated. You've taken you've applied the formula here. It's a 20% tax rate. So your calculation is 100,000 times 0.8 or $80,000. Very straightforward math. Okay, so we've talked about cash inflows. Now let's talk about cash outflows. Right, as we talked about in any investment, there's going to be cash coming in. There's going to be cash going out. In the coffee business, we would have startup costs in terms of cash outflows, as well as the continued purchase of coffee supplies to run the business. And those would be things that we would want to account for in our investment decision. So in this particular case, outflows are estimated at $70,000, and there's a tax rate associated with those outflows of 30%. So the question here again is, what are the net cash outflows? So stop the video here. In fact, go back to the original slide to identify what the formula is that would be used here, and then take a shot, and then we will proceed on. Okay. Here again, the math is very straightforward. 70,000 times 0.70 or $49,000. Again, amplifying how you would put these various variables in the equation. You come up with the $49,000 number. Okay, another question. So this is the third part of it, which is assets associated with an investment decision. So you have an asset which will cost $100,000. That's going to be used for 10 years. It is depreciated uniformly over its life at a tax rate of 25%. What is the tax shield? And as we talked about again, depreciation is an expense associated with the use of an asset over time. So in this particular case, it's saying that you're going to depreciate it over 10 years using a straight line method. So here again, go back to the original equations that were shown in the earlier slides and take a shot at figuring out the answer for this particular problem. Okay, so I hope you you did take a shot at it. So the depreciation that would be associated with this particular asset, we would take $100,000, we'd divide it by 10 years. That would be depreciation of $10,000 per year, depreciation expense. The tax associated with that would be 10,000 times 0.25, which is your tax rate, and therefore you would have a inflow of $2,500 for this particular part of the net present value calculation. All right, and last but not least, you have another sale of an asset which is going to be valued at $10,000 and sold for $15,000. So you have a gain on this particular asset. And here again, an example of this might be if in the coffee business, Dr. Cook wanted to only do that particular business for 1 year and then start a different business for the transition students the second year. She would then sell the assets associated with that business at the end, and that's what this particular calculation takes into account. So I'd like you to also stop the video here. Again, go back to the equation shown in the at the beginning of this particular video, and take a shot at solving this particular problem. All right, I'm glad you did that. So you would typically use a worksheet very similar to this to do the problem. You'd have your proceeds less the book value, the gain, the tax rate, and the taxes paid on that gain, and therefore you would have an inflow. So your answers here would look something like this. You'd have proceeds of $10,000, the book value, I'm sorry, proceeds of $15,000, a book value of $10,000, and a gain of $5,000. You would then apply the tax rate, and you have approximately $1,750 in terms of taxes paid on the gain. Your cash inflow then would be $13,250. All right, guys, let's look at one last example where you sold an asset but you took a loss, and your tax rate is 20%. So the question here again is, what is the after-tax cash inflow? Here again, stop the video, go back and look at the equations that are shown at the earlier slides, and take a shot at solving this. Okay, here again you would use a similar type of format. You'd have your proceeds less the book value, the loss, the tax rate, and the taxes paid on the gain to look at your after-tax cash inflow. Again, here you're substituting the variables into the worksheet here. You had an asset that was sold for $8,000. It had a book value of $10,000. Your loss was $2,000. Your tax rate is 20%, and therefore taxes paid were $400. Your inflow was $8,400 because you had a gain from the loss. All right. Last but not least, what other factors should you consider in an investment decision? You need to take into account your own gut, and that's called human judgment in accounting. In the accounting world, does the investment fit with the strategy of the business? Is it congruent with the strategy of the business? If it's not, you need to take that into consideration in your decision process. How much uncertainty is there in that particular investment? With anything, there's risk and there's reward. Uncertainty is a risk, but if there's significant upside that would provide operating leverage, meaning that you could do things better, faster, cheaper, at a significantly higher rate as a result of this investment, that should be taken into consideration. And then the qualitative factors. We talked about the balanced scorecard approach in the early chapters of our course. Taking into consideration all the things that are going to be impacted by this particular decision, not necessarily just financial. How is it going to affect the well-being of your employees, the well-being of your customers? You would apply the balanced scorecard approach to this to an investment decision. All right, guys. So we are at the end of the videos for this particular chapter. You should here again take good notes. Make sure you understand how to take into consideration the tax factors involved and how to do the calculations, and be very familiar with the formulas, because this will be part of the quiz tomorrow as well as on the final test. So have a great night, guys.